This video is for guidance and education. Please make sure you watch the full video to the end, because the later sections explain the key risks associated with different types of investments and will help you make more informed decisions before putting your money anywhere.
Welcome to the Explainers. So if you're a focused learner looking to stop watching your hard-earned salary mysteriously, vanish by the end of the month, you are in the exact right place. Today, we're going to transform that disappearing income into growing structured wealth. We'll break down the absolute fundamentals of investing, making it practical, totally accessible, and ready for you to actually apply right away. Let's get into it. To kick things off, I want you to imagine a young Nigerian worker named Ada, right? She gets her salary at the end of the month, and almost instantly, poof, it vanishes. It goes to transport, it goes to food, data, family support, rent, and of course those inevitable little emergencies that always seem to pop up. By the end of it all, Ada is left just staring at her account balance, asking a really familiar question. How can I make this money grow instead of just watching it disappear? Honestly, that familiar frustration, that is the exact starting line for investing.
Now, in Nigeria and truly anywhere in the world, there's this massive misconception that investing is exclusively for super wealthy people sitting in high-rise offices. But the reality is actually so much different. Investing is for the trader, the student, the artisan, the civil servant, the entrepreneur, parents. You absolutely do not need millions to begin. You can start with just a really small monthly amount. In fact, starting small is exactly how you learn the ropes without putting your entire future at risk.
Section 1. What is investment really? The fundamentals.
Okay, so before we jump into the specific tools, we kind of need to redefine what we're actually doing here. Look, investment isn't some magical get-rich-quick scheme. It simply means putting money into something today with the clear hope that it's going to grow, produce income, or, and this is huge, protect your future purchasing power from the constantly rising costs of everyday life. To pull that off, our source material lays out a simple three-step secret formula to help you pick the perfect investment vehicle. Number 1, match your goal. Like, what is this money actually for? Number 2, assess your risk tolerance. Be honest, how much of a financial roller coaster can your stomach actually handle? And number 3, determine your timeline. Exactly when will you need to pull this cash back out? If you lock these 3 variables in, you'll ensure you pick the right path without jeopardizing your future.
Moving right along to Section 2, Short-Term Savings Upgrades, Money Market and Fixed Deposits.
So if you need your money in just a few months, traditional investing in, say, volatile stocks, yeah, that might not be the best play. Instead, we want to upgrade your immediate savings. The very first tool in our arsenal is the money market fund. I want you to think of this as a much better organized savings pocket. Instead of your cash just sitting completely idle in a regular bank account doing absolutely nothing, a licensed fund manager takes it and invests it in short-term, highly safe instruments. Basically, it acts as a safe parking spot for your money that actually earns a return. But importantly, it isn't locked away completely. You can still access it when you really need to. Let's consider Bola in Port Harcourt as a really practical example. She has exactly 200,000 naira that she's saving up for her house rent, which is due in just 4 months. Now, if she leaves it in her normal spending account, she might be tempted to, chip away at it for daily expenses. Instead, she parks that 200,000 in a money market fund. It earns a nice little bit of return over those 4 months, and when the landlord finally comes knocking, she can just request her withdrawal and pay her rent with total ease.
But what if you know for a fact you don't need immediate access at all? Well, that brings us to fixed deposits. This is the ultimate keep-it-safe option at your bank. You literally walk into your bank and say, hey, keep this money for me for a set period and pay me something extra later. The crucial point here is that you are guaranteeing your return. The bank agrees on the interest rate right up front. The only catch, you just have to watch out and make sure the interest rate they offer actually beats the rising prices of everyday things, like food and transport.
To see this one in action, let's meet Amina in Lagos. She has 500,000 naira sitting idle, and she absolutely knows she won't need to touch it for the next 6 months. So rather than letting it just gather digital dust in a standard savings account, she locks it away in a fixed deposit. At the end of that strict 6-month period, she is guaranteed to get her principal 500,000 back, plus all that agreed upon interest.
This specific strategy perfectly translates patience into literal financial growth. You are actively trading your immediate access for a guaranteed, steady return over a specific, locked block of time. It's a fantastic trade-off if you have the discipline.
Which brings us to Section 3, Lending to the Government.
let's talk about T-bills and bonds. Now, if you have a slightly longer horizon, say a year or maybe a little more, we can actually step things up into highly secure government-backed growth vehicles. First up on the list are Treasury bills, or as they're commonly known, T-bills. When you buy a T-bill, you are essentially lending your money directly to the federal government for a short period of time. At the end of that period, they just hand you your money back along with a profit. And because these are entirely backed by the government itself, they're considered a highly secure alternative to throwing your money into risky business schemes.
Let's look at Tunde in Abuja. He's planning to buy a car in exactly 1 year, and he has a cool 1 million naira saved up for it. Instead of keeping it somewhere he might accidentally spend it on daily luxuries, he buys Treasury bills through his bank or a stockbroker. So, his million naira is securely held by the government for that entire year, safely growing. Then, he simply collects his principal plus his profit right at maturity, perfectly in time to go car shopping.
You see, the real beauty of Treasury bills is their totally predictable structure. The standard lock-in periods are typically 3 months, 6 months, or 1 year. This means you can perfectly time exactly when your profit lands in your account to match whatever specific goal you're saving for, exactly like Tunde did with his 1-year car plan.
But wait, what if you actually want to lend your money out for even longer? Well, that is exactly where bonds come in. A bond is basically a longer-term loan to a government or maybe a company. But here's the really exciting part about bonds. Instead of making you wait until the very end to see any profit at all, they promise to pay you interest periodically throughout the life of the loan. It is the ultimate tool for generating a steady, predictable income stream over several years before they finally return your main money at the very end.
Now, we definitely have to do a quick risk assessment here because you basically have two main choices. Government bonds offer really high safety and lower risk, simply because, well, governments very rarely go completely out of business, right? On the flip side, you have company or corporate bonds. Now, these will usually pay you a higher interest rate, but they rely entirely on the financial strength of that specific company. If that company fails, your investment is at risk. It's that classic trade-off we see all the time: bulletproof safety versus higher potential payouts.
For example, take a civil servant who is seeking steady future income. They might invest in an FGN savings bond, and in return, the government deposits interest directly into their bank account periodically. This gives them actual cash in hand along the way, while keeping the principal amount completely safe, ready to be returned at maturity. Honestly, it's just a fantastic way to receive passive income while you wait.
Section 4. Your next financial step.
So today we've seen how everyday people, Bola with her rent, Amina with her idle cash, Tunde with his car fund, and our civil servant building passive income, how they all use structured tools to transform financial anxiety into organized, growing wealth. And the best part? They didn't need millions to start. They just matched their specific goal to the right financial tool. So I'll ask you, which strategy matches your goal? But even more importantly, I really want you to ask yourself this: what is the true cost of doing nothing? Because every single day your money sits idle, inflation is quietly eroding your future. It is time to stop watching your hard-earned salary disappear and take your very first step into investing today. Thanks for joining me on this explainer, and I absolutely cannot wait to explore our next topic with you soon.
Please like, share, and subscribe to Master Sense by Faraday, and turn on notifications so you don't miss new and upcoming videos. Drop a comment below and tell us what you'd like to see next.
Welcome to this explainer. Today, we are diving right in and cutting through the noise of the Nigerian financial market. We're going to look at the actual mechanics of pooled versus market-based investments and figure out exactly how to strategically position your capital. Let's get to it.
Now, how do you even start without feeling completely overwhelmed? Even for seasoned investors, navigating the sheer volume of options out there can cause a bit of analysis paralysis. So let's look at how to properly structure your market entry without getting bogged down in all that complexity.
When you look at the landscape, we essentially have two main pathways for our capital. We're either pooling our money into managed funds or ETFs, or we're taking the direct route. And by direct, I mean buying right into banks, factories, and distinct assets on the Nigerian Stock Exchange. It's a bit like choosing between taking a bus or driving your own car.
To make sense of this, we'll quickly cover the basics of market-based investments, move into mutual funds, explore the basket approach of ETFs, look at direct stocks, and finally, figure out how to choose your specific path.
All right, let's kick things off with our intro to market-based investments. The biggest myth out there, thinking you have to manually pick every single stock, bond, or treasury bill to be effective. You absolutely don't. Actually, scratch that. Doing it all yourself can sometimes be a disadvantage. There are structural mechanisms built specifically to leverage professional expertise on your behalf, so you don't have to do all the heavy lifting.
Which brings us right into our second section, mutual funds and getting that professional help.
So, mutual funds. Think of these as a giant pool of capital. They collect money from a bunch of people and hand it over to a professional fund manager. This is fantastic because it gives you immediate broad-scale diversification. You get the benefits of the market without having to sit there staring at the Nigerian exchange every single day.
To put this into perspective, let's look at an everyday investor. We'll call her Ngozi. Say she allocates just 20,000 naira every single month into an actively managed money market fund. Because she has that professional help, her manager takes her 20,000 naira, pools it with everyone else's cash, and deploys it into specific, safe assets. We're talking Treasury bills, commercial papers, and bank placements. The professional handles all the research and execution completely seamlessly for her.
Now, the contrast here is super interesting. It's really the difference between relying entirely on that professional management versus deciding to buy a basket of assets yourself on the exchange. Like I mentioned earlier, it's kind of like the difference between hiring a chauffeur and finally deciding to take the wheel yourself. Moving away from total professional management means you are now controlling the navigation.
And that leads us perfectly into Section 3, ETFs, or what we call the basket approach. So what exactly is an exchange-traded fund? Well, an ETF is literally just a curated basket of investments that you can buy and sell directly on the stock exchange. It offers incredible structural efficiency because you trade this whole basket just as easily as a single stock. It's a real game changer if you want sector-wide exposure without the headache.
Just imagine a physical basket bundling together different commodities and market trackers. With one single purchase, you grab the whole basket. This grants you diverse exposure to multiple entities on the exchange, completely bypassing the friction of making dozens of individual, separate transactions.
But we do have to remember, buying that broad basket doesn't just magically eliminate market volatility. An ETF's value will still rise and fall. Knowing exactly what is inside your basket is absolutely vital. And for some people, they prefer to skip the basket entirely. Which brings us to the most hands-on step, direct ownership.
Let's look at Section 4, stocks, and what it means to actually own the company.
Buying individual stocks or shares means you are taking a direct equity stake. You literally own a small part of a company, whether that's a listed bank, a telecoms provider, or a manufacturing plant. So if an investor, let's call him Chidi, buys shares in a listed Nigerian telecoms giant, he becomes a part owner. He directly assumes the risks and the rewards of that business.
As an equity owner, Chidi can make money in two primary ways. First, through dividends, which is simply the company sharing a slice of its actual profits with him. And second, through price increases or capital appreciation, meaning he can sell those shares later down the line if their market value goes up. But here is the catch with direct equity. It means direct exposure to market swings. If the market falls, the value of your shares can absolutely reduce. It demands serious patience. Honestly, it's a lot like sitting through peak Legos traffic. You really have to have the stomach to weather a downturn without panic selling.
All right, bringing it all together now in Section 5, choosing your investment path.
We've climbed this ladder of involvement today. At the base, mutual funds offer you complete delegation and instant professional diversification. One step up, ETFs give you that tradable basket approach for broad, easy exposure on the exchange. And finally, at the top, direct stocks offer targeted ownership, but require a good deal of patience and research.
So, here's the question we have to end on. Which of these paths actually fits your lifestyle, your risk appetite, and your patience? Because in a dynamic market like Nigeria, the only truly bad investment is just sitting on the sidelines while inflation slowly erodes your cash. So, are you ready to finally make your money work exactly as hard as you do?
Please like, share, and subscribe to Master Sense by Faraday, and turn on notifications so you don't miss new and upcoming videos. Drop a comment below and tell us what you'd like to see next.
Welcome to This Explainer. Today we're going to demystify 7 distinct investment vehicles available right here in Nigeria. Whether you're just starting out or, looking to optimize your existing assets, we're going to explore how you can strategically grow and, just as importantly, protect your wealth. We've got a lot of really fascinating ground to cover, so let's just jump right in. It all really boils down to one fundamental question: how do you protect your wealth in Nigeria? We have to ask this vital question to truly figure out how to balance the deep appeal of potential returns with the sobering reality of the risks involved in our unique market. Because let's face it, every investment carries risk, and navigating them smartly is absolutely crucial for long-term success. So here's our roadmap for today. We're going to cover land, gold, and commodities, then agriculture and small businesses, protecting against Naira weakness, cooperatives and thrift schemes, and finally, planning for your retirement. All right, let's kick things off with Section 1, land, gold, and commodities. When we look at traditional stores of wealth, the kind you can actually see and touch, many Nigerians naturally gravitate toward real estate, and it's pretty easy to see why. Investing in land, houses, shops, or commercial buildings offers a real sense of permanence. There's this widespread hope that values will naturally rise as development spreads out to places like Ibujuleki, Abuja, Port Harcourt, or Ibadan. But there are definitely two sides to the real estate coin. On one hand, you have the hopes. Property value increases over time, and you can earn a steady income from rent. Sounds great, right? But on the other hand, the risks are very real. Property is highly illiquid. That means it takes a significant amount of time to sell it for cash if you're ever in an emergency. And, of course, there's always the looming threat of property disputes. So real estate is simply not something to rush into. So the absolute most crucial thing before you part with your hard-earned money is to run through a strict verification checklist. You absolutely must check the land documents, verify the location, confirm government approvals, physically go out there and assess the access roads and drainage, and heavily investigate any potential family ownership issues. Honestly, doing this kind of due diligence prevents incredibly painful disputes down the line. Now, this desire for tangible assets definitely extends to commodities too. Things like gold, agricultural produce, and oil-related products are super popular for preserving wealth, especially during times when fiat money is, losing its purchasing power. Gold in particular is widely viewed as a rock-solid store of value. But it's not as simple as just buying it and putting it in a safe somewhere. When buying gold jewelry or small gold bars here in Nigeria to preserve your value, you've got to keep this warning in mind. Authenticity is everything. You have to confirm the quality to avoid fake products, and you really must understand the stark reality that commodity prices fluctuate. Depending on the market, your selling price could actually end up being lower than what you bought it for. No one wants that. Moving right along to Section 2, agriculture and small businesses. Now, stepping into what I like to call the active hustle, we find investments that require real hands-on operational oversight. Since Nigerians literally must eat every single day, agriculture, whether that's crop farming, livestock, or food processing, is a highly practical area of investment. For example, a group of friends pooling their resources to start a poultry farm in Ogun State, or maybe a fish farm in River State, can do incredibly well, provided it's properly managed. The profits can be sky high for sure, but the risks, they are equally substantial. Bad weather, an outbreak of disease, skyrocketing feed costs, or just plain poor management can easily wipe out your returns in a flash. Because of this, you really need to be highly skeptical of any agricultural schemes promising massive, guaranteed profits without clearly explaining exactly how your money is going to be used and protected. Speaking of clear explanations, let's talk about small businesses. It's super common to invest in ventures like food sales, fashion, tech, or logistics. But if a relative, say your cousin, asks you to invest 300,000 naira in a small logistics business in Lagos, you have got to separate family ties from financial reality. Basically, never invest simply because the owner happens to be a friend or relative. Instead, you need to demand some clear answers to crucial questions. Is there a real demonstrable market for this product or service? Who is actually managing the money on a day-to-day basis? Are there proper financial records being kept? And critically, what exactly is the plan if the business fails or loses money? Always ask for a simple business plan, a breakdown of expected costs, and a formal profit-sharing agreement. Get it in writing. Okay, let's shift gears to Section 3, protecting against Naira weakness. When tackling macroeconomic realities, we really need to look at how investors hedge against currency depreciation. To reduce the sting of the Naira losing value, many Nigerians keep a portion of their wealth in dollars. For instance, a parent who's diligently saving for a child's university fees abroad might wisely utilize domiciliary accounts, dollar mutual funds, Eurobonds, or approved offshore investment products. It's a highly strategic move to preserve your purchasing power on an international scale. However, you've got to carefully weigh the pros and cons here. While the reward is that it protects your overall value against Naira depreciation, the risks are pretty substantial. Exchange rates can jump around unexpectedly, investment platforms can straight up fail, foreign markets can drop, and the fees can be incredibly high. So the main takeaway is that you must always verify the credibility of the institution, double-check their withdrawal rules, and completely understand all the charges before sending your money abroad. All right, next up is Section 4, Cooperatives and Thrift Schemes. Here, we're diving into community wealth. We're looking at culturally relevant, collective solutions for saving and borrowing that have literally powered Nigerian communities for generations. Cooperatives are extremely common in Nigerian offices, churches, and trade groups, and honestly, a good staff cooperative is a powerful tool. It helps members pool their resources together, save consistently on a monthly basis, and most importantly, access loans at friendly rates for pressing needs like rent, school fees, or even capital for a small business. But listen, a badly run cooperative will literally lose your money. Before you commit a single naira to one, you need to look for the hallmarks of a strong co-op. We're talking clear rules, proper record keeping, and trusted leaders. They should be holding regular meetings, clearly explaining exactly how the members' money is being invested, and they should be providing transparent, audited accounts. Don't settle for less. And finally, we arrive at Section 5, Planning for Your Retirement. This is the inevitable future, folks, the ultimate long game, and really the final destination of our investment journey. A pension is simply money safely set aside for that time when you finally stop working. Here in Nigeria, a lot of workers use a retirement savings account, which is managed by highly regulated pension fund administrators, or PFAs. And this money isn't just sitting idle in a vault, it's being actively invested over time so that you will have a reliable income waiting for you when you retire. Let's consider a scenario. A young worker earning 250,000 naira monthly might feel that retirement is, decades away and totally not worth worrying about today. But by following a few simple steps, starting early with regular contributions, they give those funds the crucial time they need to compound and grow. If they can add voluntary contributions on top of that, wow, it grows into incredibly meaningful retirement support. The math is honestly simple. The earlier you start, the more time your money has to grow. It's literally like planting a tree. Old age comes to us all eventually, so I highly encourage you to take active control of this today. Please don't leave it to chance. Check your pension statements regularly, know exactly what fund type your money is sitting in, and stay actively engaged with your PFA. As we wrap up this explainer, I want to leave you with one really vital question. Have you verified the foundations of your financial portfolio today? Whether it's demanding that land survey, double-checking the hidden fees on your dollar mutual fund, or just finally logging in to view your pension statement, I challenge you to take your very first actionable step toward securing your financial future today. Thank you so much for joining me on this journey through wealth building. Keep learning, keep verifying, and keep growing.
Please like, share, and subscribe to Master Sense by Faraday, and turn on notifications so you don't miss new and upcoming videos. Drop a comment below and tell us what you'd like to see next.
Hey everyone, and welcome to this explainer. Today we are grabbing our compasses and mapping out the Nigerian financial landscape. Whether you're just starting to set aside a little extra cash, or you're really looking to solidify your financial future, navigating the whole world of investing can sometimes feel like trying to read a map in the dark. But it really doesn't have to be that way. Consider this explainer your personal guide to demystifying exactly how to put your money to work right here in Nigeria. We're going to break down the complexities, ignore the noise, and just focus on practical, step-by-step strategies for building lasting wealth. Okay, before you even think about putting a single naira into the market, you absolutely have to answer this foundational question. Why are you investing, and when do you actually need the money? It sounds incredibly simple, right? But skipping this step is literally where most people trip up. You see, your timeline dictates your strategy. If you need money for your child's school fees next term, well, that money absolutely cannot go into a highly volatile, risky investment. You need that cash safe and ready to go. On the flip side, if you're building a retirement nest egg that you won't even touch for 20 years, you can afford to explore investments that grow over time, even if they bounce around a bit in the short term. Clarify your timeline first, and I promise the rest of the puzzle just starts to fall into place. So here's our roadmap for today. First, we'll figure out the right investment mix. Second, we'll look at a simple Nigerian portfolio. Third, we'll talk about beware the main risks. Fourth, dodging investment scams. And finally, we'll wrap up with the golden rules for investing. All right, let's dive right into Section 1, the right investment mix, balancing your goals and risks. You've probably heard this saying a million times. Do not put all your eggs in one basket. But listen, in investing, this isn't just some old cliche. It's literally your ultimate rule of survival. True financial safety comes from spreading your money across different types of assets. You want a mix of safer, predictable investments that sort of act as your anchor, combined with growth-focused investments that act as your engine. If one basket drops, hey, you still have eggs in the others. This strategy is called diversification, and it's exactly how smart investors protect themselves from the unpredictable swings of the economy. Now, a really vital part of that mix is your emergency fund. Keeping your emergency money completely separate in a safe, easy-to-reach place is a non-negotiable. Why? Because life happens. The car breaks down, a medical emergency pops up, or the roof starts leaking. If all your money is locked away in long-term investments, you're going to be forced to sell them off in a total panic just to get the cash you need, often at a major loss. By building a dedicated emergency buffer first, you give your long-term investments the uninterrupted time they need to actually grow. Moving right along to Section 2. A simple Nigerian portfolio, or what we'll call the 100,000 Naira map. Imagine you have a starting capital of 100,000 Naira. How do you slice that pie? Well, this chart gives us a fantastic baseline to look at. You might put 30%, that's 30,000 Naira, straight into emergency savings, keeping it liquid and safe. Another 30% could go into a money market fund, which offers a bit more interest while still being super low risk. Then you allocate 20% to government treasury bills or bonds, locking in a really secure return over a set period. Finally, the last 20% is your growth engine, maybe carefully selected stocks or even seed money for a small business idea. Now, obviously, the exact mix depends on your personal risk appetite, but this is exactly what diversification looks like in action. It's balanced, it's structured, and it completely covers all your bases. Let's shift gears a bit for Section 3. Beware the main risks, protecting your wealth. So, two of the absolute biggest hidden dragons out there are liquidity risk and currency risk. Liquidity risk is what happens when your money gets trapped. Imagine you invest everything you have in a piece of land. Now, land can be an awesome investment, but if an emergency strikes tomorrow, you can't just sell a plot of land in an hour to get cash, right? That inability to sell quickly is liquidity risk. Then there's currency risk, which is incredibly relevant in Nigeria. This is the risk that the naira might lose value against foreign currencies like the dollar. If your investments are only growing by 5% a year, but the currency loses 10% of its global purchasing power, you are actually moving backward. Understanding these two concepts is totally essential for structuring a resilient portfolio. And risk can come from so many different directions. It's not just about a sudden stock market crash. You have inflation risk, where your money grows, sure, but the cost of tomatoes, fuel, and rent rises way faster, just eating away at your real wealth. There's credit risk, this super simple danger that the person or company you lent your money to just fails to pay you back. Then you have traditional market risk, where the overall prices of shares just drop. And we can't forget regulatory risk, where a sudden new government policy or tax rule completely changes the profitability of your investment literally overnight. So how do you actually fight back? The absolute best defense you have against inflation, market crashes, and fraud isn't luck. It's education and preparation. By acknowledging that these risks are out there, you can intentionally choose a diverse mix of investments, like we saw in our 100K map, that naturally shield each other. When you understand the battlefield, you can armor your money accordingly. Okay, on to Section 4, dodging investment scams and identifying the traps. We need to be incredibly direct here, folks. If you are scrolling through WhatsApp, Telegram, Instagram, or TikTok, and someone messages you with a promise to double your money quickly, alarm bells should be ringing loudly in your head. These platforms are just flooded with bad actors right now. They create incredibly slick, professional-looking websites, they post fake testimonials, and they use really high-pressure tactics. But make no mistake, these are unlicensed, dangerous schemes peddling impossible returns. The real market simply does not work that way. So, the crucial point is this. You must remain guarded and verify absolutely everything. If an investment firm approaches you, do not just take their word for it. Check with the appropriate regulators, like the Securities and Exchange Commission in Nigeria, to ensure they are actually licensed to handle your money. Run far away from anyone promising guaranteed high profit returns with zero risk. Let me say that again. In the world of investing, zero risk and high returns never, ever sit in the same room. Your skepticism is your safety net.
We've made it to Section 5, the Golden Rules for Investing, your simple checklist.
All right, this is your rapid-fire checklist for safe investing. Number 1, know your goal before you put a single kobo down. Number 2, only use licensed banks, stockbrokers, fund managers, or pension administrators. Number 3, actually read the terms, the hidden charges, and the withdrawal rules. Don't just blindly click accept. Number 4, spread your money around, diversify. Number 5, don't just set it and forget it. Review your investments regularly to make sure they are still on track. And finally, number 6, if you are confused, ask a qualified advisor. There is absolutely no shame in seeking professional clarity. I really want to highlight this brilliant local rule of thumb because it is truly the anchor of this entire explainer. If you cannot explain the investment in simple English or Pidgin to a friend, you probably do not understand it well enough. Think about that. That is the ultimate test. Do not invest out of FOMO, that fear of missing out. Do not invest just because your friends are doing it. If you can't break down exactly how the money is made in a simple conversation over a meal, you should not be putting your savings into it. Complexity is very often just a hiding place for risk.
Remember that investing is not some exclusive club just for the wealthy, and it is certainly not a get-rich-quick scheme. It's a patient, step-by-step journey that is wide open to anyone willing to start. You can invest through Treasury bills, mutual funds, real estate, agriculture, or business. The key is to just start with what you understand, manage your risks, avoid the trap of greed, and let time do the heavy lifting.
As we wrap up this guide, I want to leave you with one final, provocative question to ponder before you make your next financial move. Ask yourself honestly, can you explain your next investment in simple Pidgin? If you can, you are on the right track to building lasting wealth. If not, maybe it's time to take a step back, do a little more reading, and ask a few more questions. Stay empowered, stay cautious, and take that next step toward your financial freedom. Thanks for learning with us today.
Please like, share, and subscribe to Master Sense by Faraday, and turn on notifications so you don't miss new and upcoming videos. Drop a comment below and tell us what you'd like to see next.